The next guest on Smarter San Diego TV is a board-certified tax attorney and very talented blogger. Please welcome Jeffrey Kahn.
Jeffrey Kahn is here. What's up, man?
Yes. Hi, Derek. Nice to see you.
Good to see you too, brother.
Yeah.
Year-end tax tips. You're always crucial with these. Every year you've got great tips for people at the end of the year, before they're filing taxes, before it's too late to make any changes. What have you got for 2015?
That's right. Well, I got a number of things. Okay. So first of all, deductions. Everyone has deductions. Everyone loves deductions.
Of course.
So what you need to look at is whether you want to pick up more deductions this year or defer those deductions into next year. Okay.
You can do that.
You could do that. You could do that.
That's interesting.
Okay. And so one of the most common deductions to do that with is mortgage interest.
You can do that with mortgage interest?
That's right. Everyone's got a mortgage. And every time you send in your monthly payment on that mortgage, you're paying for principal, you're paying for interest, and the escrow for property taxes, insurance, that kind of stuff. It's that interest portion that you'll get a deduction for, but only in the year that you make the payment. So, for those people who just schedule their monthly mortgage payments, say like the first of every month, you make your December 1st payment, the interest that you paid on that payment will be included in 2015. But when you make your next scheduled payment on January 1st, since you're making that in 2016, that interest that you paid for will now get credited to 2016. So here's a trick. If you're looking to accelerate deductions into 2015, why not make that January 1st payment at the end of December? As long as your mortgage company cashes that check or gets the payment before January 1st, you've just paid in your December interest in 2015 and essentially got an extra 1 month's worth of mortgage interest to deduct on your 2015 taxes.
Very interesting. So you would do that if you were in a situation where you knew you were going to be in a lower tax bracket, let's say this year versus next year, or you anticipated that, or where you needed an additional deduction. Why would someone want to do that?
Well, you'd want to accelerate deductions if basically you want to pay less in taxes. You want to lower your taxable income for 2015, so you want to accelerate deductions. But let's say like next year, you're going to be in a higher tax bracket. To have a tax deduction next year is going to be more valuable because it's worth more.
Right.
It's worth more. So you may want to defer making that payment or making it when you normally do, January 1st.
Okay.
And get the deduction next year.
Okay, so if you think you're going to make more next year, then go ahead and wait and make the payment on schedule.
Yep.
If you think you did really good this year and you don't know if you'll do so well next year, go ahead and take it right now.
Correct.
Bird in the hand, Rebecca. Bird in the hand. I hope you're listening.
Oh yeah.
Good stuff. So Jeff, obviously this has been a big year. The last couple of years have been big for Obamacare. Cover California, let's call it for California. So is there anything that we need to know about 2016? Is that the year that it all kicks off, or what do we need to know from a tax perspective about Covered California for 2016?
Well, I think the big thing from a tax perspective is Covered California does something really nice. You know, the whole confusing thing about Obamacare is getting that tax credit. If you're entitled to it, how much, and it's just a complete mess in doing that. I think you need a supercomputer, really, to figure it out, okay? But Covered California does something really nice. And basically, for those people who have filed their 2014 tax return, okay, IRS has a record of what you earned last year. Covered California says if you go to their website and you complete their consent allowing the IRS to release your 2014 tax information to them, they will then go ahead and compute how much your credit is and inform you of that. And now you have, from Covered California, the amount of the tax credit you're entitled to claim. So I think that's a great tool for anyone who's on Covered California to go ahead and subscribe to.
Absolutely.
I know I will be.
Yeah. Beck, question of the week.
Question.
We're ready for it.
Question of the week. can I claim my cat on my taxes? No, just kidding. Just kidding. But seriously.
People probably try to do that, don't they?
Hey, she's like my child.
Not with you.
She's like my child. She's my baby.
You're dependent, right?
Yeah. But who can I legitimately claim as a dependent on my taxes?
That's a good question.
Okay, that is a good question.
A lot of people try to claim lots of stuff.
I know.
I know you know this.
I do know
So
that.
who can we legitimately claim as a dependent?
Well, the IRS basically classifies it into two categories: children, and then we'll say other relatives.
Okay.
So with the children, it's pretty well much straightforward that you have to provide more than half the support, and it's usually not a problem except when you've got divorced parents. Because now there's an issue as to who legally is entitled to take an exemption. Many times it's dictated in the marital settlement agreement who's going to take the exemption. And there could be weird formulas like, okay, we had one child together, so in the odd years you get the exemption, in the even years I get the exemption.
Oh, and you can do that?
Yeah, you could do that.
Oh, I didn't
you
know
could
you could
go
do
ahead
that.
and do that. Okay, but absent what the marital settlement says, and the IRS has got some tricky rules, because what they usually figure is whoever has custody of the child is the one who presumably gets the exemption. So if you don't have custody but you're furnishing more than half the support, and the marital settlement agreement is silent as to who gets the exemption, then there's actually a separate form, there's information you need to provide to the IRS with your tax return in order to get that exemption for the child.
Yeah, I would imagine if both, let's say, mom and dad, both claim child as a dependent, IRS is going to know.
Oh, they're going to pick that up. Because remember, whenever you list somebody as a dependent, you have to include their social security number. And of course, all it takes is the IRS computer to run a matching program on those dependents, and they see, oh, there's two returns claiming the same social security number as a dependent. And that's what triggers it.
Okay.
Yeah.
So no cats. Children, usually not a problem unless there's a divorce.
Correct.
And the parents aren't quite sure what to do. What about adults? Let's say I'm taking care of grandma, or someone else maybe has a disability, and I take care of them full time. Can I claim someone like that as a dependent?
Possibly. Possibly. There's just a lot of restrictions and limitations and requirements that you need to go ahead and look into. So usually for these other relatives, they need to live with you. However, there is an exception for parents. So mom or dad, you're supporting them, and they are in perhaps an assisted living home or something like that. Even though they don't live with you, if you meet the requirements where you furnish more than half their support, they don't earn income above a certain threshold, then you can still claim them as an exemption. But for the most part, for other relatives, they're going to have to live with you.
Okay. All right. Great stuff. Jeff, any more last-second, year-end tax tips? You got the mortgage deduction. Is there anything else we should be thinking about?
Oh, yeah. Everyone, before the end of the year, clean your garages out, clean your closets out, because you've probably got tax deductions in there. And the key is, when you go ahead and collect those items and you bring them over to charities that do accept, these items, what you want to do is don't just throw all the clothes in a bag and bring them over and get your receipt and put on it one bag of clothes. Because a year, 2 years later, when you're selected for an audit, how are you supposed to prove what was in that bag and the estimated values of what you gave? So what you want to do is you want to do an itemized list of what it is that you're giving, okay? Kind of identify what you believe the estimated value is based on the condition and style and stuff like that. And then I would even take it one step further. Everyone's got smartphones. Everyone's taking selfies of themselves. Why not, before you put those clothes in the bag and you have your itemized list, lay them out on the dining room table, take pictures of the clothes, and keep it with the list? I think it's a great idea.
Spoken like a true tax attorney badass, Rebecca.
Yeah.
That's how you keep the IRS off your back right there.
That's right.
Been taking a lot of notes this segment.
Take notes for sure. Jeff, really appreciate your time. Thank you
Okay.
so much for coming in
Thanks,
today.
Derek.
It's board certified tax attorney Jeffrey Kahn. Stick around for more Smarter San Diego TV, where we guarantee to make you smarter than everyone else.